Hey everyone, welcome back to Apex Pickz and your go-to channel for daily stock market insights. Today we're breaking down the biggest market movers. We're going to break down the sector highlights, what to watch next. For today being Thursday, Wall Street had an action-packed day. We saw several moves in the market, several large moves. Actually, as anticipated, we saw some moves into the smaller caps, and then over the day, we saw that some of those small caps actually lost a slight amount of steam, and then the big tech stocks just took off. We're talking 7% move. I saw Tesla was up 6% today. Metal was up another 4%. And if we look into those moves that we saw today, this is all reaction to the Federal Reserve cutting interest rates. We're still seeing a big rotation. We're seeing a lot of investors that were probably out of the market coming back into the market. We saw the mortgage rates go down today, I think from 6.2, 6.3, something like that, to 6% today. Now let's check into the report from CNBC and see what biggest moves we saw today. What were the biggest gainers today in today's stock market?
Stocks were already expensive, and they just surged on a 50 basis point rate cut. So why do you think investors can still buy here?
Yeah, John, thanks for having me back. Happy all-time highs, happy Talk Like a Pirate Day, and it's also my son's 12th birthday, so happy birthday to Gus. But listen, as everyone's talked about on your network a lot, the next 2 weeks are historically pretty weak in terms of kind of seasonality. October is the worst month in an election year, so let's have that kind of out there. But the reality, again, is we're not going into recession. Come on, the all year saying there's no recession. Slowing down, sure. Look at initial claims, right? 4-month lows just today. That's a good real-time indicator for what's really happening with the labor market.
Speaking too soon.
We can get into all the weeds of it, but we're looking at another 20% gain this year on the heels of last year's 20% gain. We do think, John, there's more upside once we get through the election. The one thing to think about, and I sent this to you, when the Fed cuts near all-time highs, within 2% of all-time high, like they just did obviously yesterday, about 20 times back in 1980. S&P's higher about 14% on average, higher 20 times, every single time. So listen, who knows, this is 21. We think it very well could be. Now, I'll be clear, we were about 3% away back in 2007 when they cut. So, you can always add an asterisk to it. But the reality is, don't fight the Fed. We're still in that camp here.
Okay, now, Brooke, now that the Fed has started cutting, how do you use fixed income in portfolios to balance risk? How much and what kind?
Mm-hmm. Fixed income, it's a broad spectrum. And when we look at our portfolios, we tend to buy quality, and then we'll supplement it with some high yield, but from a fund or from a manager. So right now, we're buying out 3 to 10 years, diversifying into a ladder, and really looking for high coupons, high quality, and just wanting to have that diversified maturity stream.
It's interesting.
So, Ryan, worst case, you have a market that's expensive. Best case, fairly valued. We did see this sugar high today from a 50 basis point cut, which is not the type of cut we usually get when we come into a cycle without a crisis. So does this rally have legs now, or are investors due to step back?
Let me pause that right there. That guy seems like a perma-bull. To say there's no recession around, it's a crazy thing to say. If I pull up my chart, we're at a personal savings rate of 3%. That's obviously that's down half from before the pandemic. We're at a household debt and a non-household debt. We're pretty high as Americans. This is a consumer credit report. We're pretty high right now. So to say that there is no recession in sight, or that there is going to be no recession, I think it's pretty crazy to me. But let's continue.
I can say, okay, it started here. It's time to sell the news.
Well, we could very well see some sell the news again. We talked about the seasonal. Maybe back to John's original question, asked me about valuations. I mean, look what, and Mike just talked about this, the broadening out, right? And I know small caps sometimes are a dirty word. We still like small caps. They're 12% for the year. It's not as much as large caps, no. But if you look at history, it's once the Fed starts cutting is when you see that outperformance of small caps. And we mentioned, yeah, the market is kind of expensive, but small caps are historically cheap relative to large caps. Mid caps are actually our largest overweight at Carson Group. We like that area also. So SMID in general, we think it's a lot of opportunity because the Fed's now cutting. And one other thing, hey, earnings growth is coming in. If you look at small caps earnings next year, they're like high teens. S&P's not expected to grow that high. We think that could be a little low. So we see a lot of earnings growth and cheap valuations in small and mid caps. So that's a nice part of the market that you see, you know what, I don't want to buy something pricey. That's where investors should look. And we think it still looks good the next, let's say, 6 to 12 months here.
Okay, great. I'll note FedEx earnings are out. We're going through those results. Stocks popping initially here as we do have that cross the wires. Brooke?
So basically, everything was up. If we look at this chart right here from Finbiz, everything was mostly green. Big tech, that was 100% green. I mean, you got Microsoft, Apple, Nvidia all up. Financials were up today. Communications were up. If you look at that, Google and Meta's up 4% today. That was relative to the end of the day because midday, I believe I saw Meta 5% today. So we saw an overall of the market. We saw it moving. Most of my stocks in my portfolio were definitely moving today. But regardless, after all, we saw SPY was up 1.5%. QQQ was up 2.3%, almost 3% in the day. That's a large day. These are all-time highs today. Even the Dow Jones was up today. And personally, my portfolio was up today. It started up kind of high, and this is one of my long-term portfolios. Most of the stocks that I'm gonna be holding here are gonna be for the long term. We started off kind of high, up 1%. Midday we were up 2 to 2.5%, and then as the day continued, we took a big cliff dive at the end of the day around 2 p.m. We took a big cliff dive. Right now, you're seeing my portfolio skyrocket in the afternoon because we just got some news that Nike CEO, a long-term veteran, he was actually, if you remember, he was a CEO that stepped down back in 2020, and he was replaced with the current CEO. They just announced that he's actually coming back, effective immediately, I believe. So this is, as you can see, investors taking it very positive because this is a very positive move on Nike. If you look at Nike's performance over the last 10 years or so, or I'm sorry, even looking at the 5-year chart. God, I guess it's been so many years now. If you look at Nike performance in the mid-teens, you can see how well Nike performed under the CEO. This is obviously thanks to a lot of it is thanks to Elliott Hill because while he was CEO, he focused a lot of Nike's business into a direct to customer strategy. So he was less focused on getting his Nike brand in stores. He was more focused on selling it directly to the consumer. So that was obviously a lot better for margins for the company. So during Hill's leadership, Nike experienced a lot of consistent revenue growth thanks to his focus on his consumer-driven innovation and global market expansion. So not only did they manage to expand Nike's footprint in key markets, but China, North America, and Europe were those markets that Nike was able to expand. So thanks to that model, the company's focus in digital platforms like the Nike app was able to reach consumers on a day-to-day basis. And frankly, when it comes to a consumer buying something online, at least particularly when it comes to some consumers Nike's an established brand, and if you know what your size is and what it is, you could pretty much just buy any shoe that's your size, and you're probably gonna go buy. So that was, looking back at it, that was an amazing strategy that ended up paying off in the long term. So Nike's move to come to make a change in CEO was probably a good move. Not to say that the CEO isn't doing bad, but it's kind of like, it's essentially like what's going on with Starbucks. We saw Starbucks go up, I think, 20% after they announced that the CEO. Sorry, it looks like it's been over a month ever since that CEO. But Nike did a nice Starbucks did a 20% move when we found out that the CEO of Chipotle was being poached to come over. So I believe this was announced. I hope maybe after hours. It's possible it was announced after hours, just like it was this day. So tomorrow Nike could probably have a bigger day. We're talking probably another 6, maybe 10% move from institutions or other large investors buying in. Right now in the after hours, it's just a certain group of investors that are buying. But tomorrow when the market opens, a lot of different moves are going to be happening. A lot of fund managers are going to be looking at Nike and going to be looking at the leadership, and what they're going to do is they're going to be like, well, okay, well maybe we were too hasty, and maybe we should have been buying during this dip. What's left for me to do is, will Nike go back to what it was? And frankly, probably not. I was actually shocked that they left Nike to fall this much. Investors were just dumping Nike. Sure, as a consumer, but consumer stocks sometimes are cyclical, and that's something that you have to deal with when you're owning a stock like this. But Nike is it's almost like the Netflix of shoes. Now, Netflix is a brand that's so engraved into your homes, and that expansion is so quick around the world that it's an iconic brand now. Everybody knows Netflix. Everybody has Netflix. My grandma's best friend has Netflix. It's a very cheap price. Why wouldn't they? So to see when I saw a stock down this much, and to be quite fair, it was actually Jeremy from Financial Education. He was the one that pointed out to me that Nike was so low. And I looked at it and I started buying. I think early on when I first saw the dip, I started buying somewhere around here as it go. And that's sometimes my problem with getting into positions. Sometimes I take a bigger risk than I should, and that happens from time to time. Sometimes I take a bigger risk than I should. And sometimes I jump into a position and I think that, oh, great, I'm getting a great deal, but then stock goes down another 5 or 10%, and now you're stuck, and not essentially bag holding, but now you have less flexibility that you would if you saw another great market opportunity. You don't want to take the 10% loss and then move on to a different stock. So seeing Nike go down and seeing it almost at a 5 year, 3-year low, something like that, and it was just seemed like a no-brainer to me. Even looking at the numbers, I mean, me knowing it's a consumer stock, it's gonna be cyclical. We're in a place where interest rates are high, personal savings rates are down. The consumer is surprisingly strong. So to see Nike go down, and the rates are definitely concerning, but not to say that there's not somewhere where Nike was going to be, not to say that what today's reflection of Nike is what's going to happen in the future. So when I saw that stock, I started loading up on it, and unfortunately we got some. I forgot exactly the news that we got around here, but unfortunately the stock started moving faster than I like, and typically that's always a good sign for me. It always has been. When I'm loading up in a position and it takes off, you knew that's when you knew that you were getting a good deal, because Wall Street, whoever finally caught up and saw that this was an amazing deal and that they should have been buying. So plan moving forward is probably tomorrow Nike's probably going to continue to go up. Frankly, it may stabilize, but again, this is after hours trading. So tomorrow when the market reacts to it, the institutional investors react to Wall Street, those fund managers have more time to react to, and they only buy during the average market hours, 9 to 4 or whatever. We're gonna see some moves, and I almost guarantee that this may go up higher. So in the meantime, I have, looking at Nike. Unfortunately, I think I've loaded up enough. I think I have 50 shares. I frankly, I wish I would have gotten a little bit more. I wanted to buy some calls for, I think for March, April. So I unfortunately, I wasn't. Looks like I'm not gonna be able to do that. However, I think I got these two. I think I got these two into a good price. So I got SoFi. I have an average cost on this one of $6.79. I have an average cost of Nike of, I believe, 81. So it's unfortunately the opportunity is gone. Not to say that Nike won't be 120, 150 in the future. However, it's the opportunity, the chance to get in early and make it. And that chance is gone. So, hey guys. So thanks again for tuning in. If you enjoyed the breakdown, please make sure to hit that like button and subscribe. Turn on notifications so you don't miss any future updates. I'll probably be doing daily, if not weekly, uploads. And drop a comment below with your stocks. Whatever stocks you're watching. Let's talk about it. I'm always looking for new opportunities to see in the market what could be missing. Final thoughts on Nike. If Elliott Hill rejoined Nike as CEO, this could be a big shift for the company. With his combined experience and forward, looking strategy at Nike to keep a forefront in the sportswear industry, I think we're definitely in for a good, positive quarters for Nike. So, thank you guys for watching and take care.